Hello, everybody, and thank you for joining us for another episode of the Financial Commute. I'm your host, Chris Galeski, joined by Wealth Advisor Patrice Bening. Patrice, thank you for joining us.
Thanks for having me, Chris.
In the news over the past several weeks, there's been a lot with regards to student loans. Before we get into kind of what the program was and what it transitioned to, it sounds like forbearance ends at the end of August, so interest starts accruing in September, and people are going to have to start making student loan payments again in October. Is that right?
Yep. And it's been 3.5 years. That's about 44 months of zero payments for a lot of people. And that's been wonderful, obviously, to have to be able to pause on that. However, some planning has to be done, I think. And that's why it's important we have this conversation, just creating awareness around what's available right now compared to what it was before COVID started.
Without a doubt. I mean, student loans are one of the largest debts that the economy has here in the U.S. And I often wonder how much the lack of needing to make payments on your student loans led towards or helped cause the inflation boom that we had in so many areas of our economy over the last 3 years, specifically, with travel and hotels. I mean, if people aren't paying their student loans, they're using those dollars for other things and helping drive the economy going forward.
Well, if you were to think about even a college degree can be almost tagged as one of the American dreams, but it really comes at a steep price. So to your point, when you look at the average student loan balance out there for undergrad is about $30,000, and you're looking at in the hundreds of thousands for graduate or professional degrees. Yeah. Having to pause those, it's, now you've got this extra income in your pocket that can be reallocated to other things.
Without a doubt. And it sounds like from some of the changes, that percentage of your income is significantly getting reduced. So let's start with the plan that we were under and then what some of these proposed changes are.
So before, if you had this is just to want to make clear, this applies to federal student loans only, not private loans. So the goal is to understand what's available if you took out a federal student loan. And before you had 4 options. They're all income-driven plans. Okay. You had an income-based repayment, you had an income-contingent, you had a pay-as-you-earn, and a revised pay-as-you-earn. So those were the 4 options you had before. And based on where you were in your life, that's what you chose. The main change applies to the last one, the revised pay-as-you-earn. It was called REPAY for short. Now it's been renamed SAVE, and it stands for Saving a Better Education. Saving a Valuable Education.
Okay. Saving a valuable education.
And to your point before, the way that the payments that you had to make on your student loans were based on your discretionary income. Yeah. And when you think of discretionary income in this situation is really, you're looking at your modified adjustable gross income.
Yeah.
Can't speak this morning.
It's okay.
So before that was 10%, and also looked at the federal poverty level limit, and that was 100. You had to be 150%. That was the calculation that would take in. That's been increased by 50%. So now it's reduced. It's up to 225 above the federal poverty level, and also your the amount that you make monthly is down to 5 from 10. So for folks that, especially on the undergraduate loan program, it's almost half their payment that they actually will only have to make. For graduate loans, it's not as significant because it doesn't apply the same 5 to 10. It's still the 10%. However, because it's considered less, because of the ratio of the 225% above the federal poverty level increased, it still reduces. So those folks should also see a reducement in their payments as well.
Well, that's fantastic. That's fascinating and fantastic for some people. I mean, for, I guess, undergraduate students, their student loan, it's going to be half.
Correct. So the one point that, and again, there's many nuances to these particular plans, but let's say if you were on the REPAY program before, you will automatically go into the SAVE program. So your payments will automatically see this particular, reduced monthly payment. If you were in the other 3 that I mentioned earlier, you can, if it makes sense, and this is having to really consult with your tax advisor, even your financial planner, to see if it makes sense to consolidate your federal loans into one. And it's just not refinancing your loans. So to make sure you don't want to refinance, you want to consolidate into one and then put it underneath the SAVE program. And that way you can then be streamlined and have one payment that's subject to this particular calculation.
Well, thank you for sort of clarifying that, where we were, the 4 different options, and then the new proposed changes, really just that last option, the repay program, switching to SAVE, which is going to be payments over specific amounts of time, whether it's anywhere from 10 to 25 years, percentage of your income, but that income is going to be reduced. Tell us a little bit more about that.
So another significant change that's made to the particular period of time is that if you have student loans that are $12,000 or less, typically it didn't matter that, you were still subject to the 20 to 25 year period. Yeah. You will have only after 10 years, if you still have any amount owed, that's forgiven. So that's really big, and that actually applies to both undergrad and graduate loans consolidated as a dollar amount, but it has to be $12,000 or less. And then the other big nuance that has to do with the SAVE program that I think before, let's say you went to medical school, you started a family, you're making really good income, and typically some of the programs available for the income-driven repayment plans is that, a lot of folks decided to, if they were married, and there's benefits to filing jointly when you're married, but a lot of them had to choose to file separately. However, the income payment plans still took into consideration the joint regardless of their filing status. So with the new SAVE plan, you are able to, if you were filing jointly before, and again, it has to make sense because you will lose certain credits. There's little nuances to, having how you both, can take deductions, and also if you claim children, who's going to claim who. However, there might be benefits of going from filing jointly to filing separately if you have a person in that relationship that makes significantly less income, and that's the person who has the student loan.
With the student loans.
Because they will actually can save you quite a bit of money under the SAVE plan.
Well, so just to summarize kind of some of those points there, if you're in the income-driven repayment plan, it's going from 10% of your income, modified adjusted gross income, to 5%, so a significant reduction in your minimum payment that you need to make. You do have the ability to now choose whether you're filing joint or filing separate as it relates to making these student loan payments. Correct. And then if you made payments for 10 years and your balance is $12,000 or less, that will be forgiven.
Correct.
And there were some problems with the system. So the administration is basically coming out and saying, hey, we know that there's been problems with the record keeping in the system, and we're trying to, start from scratch. So if there were people that maybe were delinquent or missed a payment, everybody's starting with a clean slate going forward, and they're trying to make up for the calculation of payments and figure out where people are at between those 20 and 25-year timetables. This is all really confusing.
It is. So the other thing that I think it's very important to understand is that before, when you consolidated your loans, your clock started again. So you were going back to a 20 to 25-year term, where now that doesn't happen anymore. So one of the changes they've made is that even if if you have 4 or 5 loans out there, you can consolidate, but your clock doesn't start again. You will get credit for all the months that you've made payments, which is wonderful. And then the other thing that's happening is that there's no longer negative amortization. So for example...
Yeah, the negative amortization, I saw that in one of the articles. Talk through that.
So before, let's say that you made payments, but you made less than what you couldn't afford to make the full payment. Whatever you did not make would get tacked on at the end of the loan. So even if, typically, if you, at the end of 25 years, you still owed a balance, that would be forgiven. But because you, let's say, did not make full payments all the time, that interest that accrued will be tackled at the end of the loan, at the end of the period, will be forgiven, but it's considered as taxable income to you at that time. So that goes away. So if you could not make full payments throughout the time of your loan, it's no longer going to be accrued at the end.
Is there a minimum amount that people would still need to make? I mean, if you're on the income-driven repayment, and it's 5% of your income, and let's say for whatever reason you can only pay 1% or less, is there a minimum, or that hasn't been ironed out yet?
That hasn't been ironed out. I was looking for that information, but it doesn't quite, even before doesn't quite delineate what that amount is, the percentages, I should say.
I think that this is a very confusing topic, and there's a lot more to come on the impact of this and what the purpose is. But from my understanding, and please clarify if I said anything that's incorrect, the purpose of this is to kind of clean up some issues that they have under the current system, but also make things easier now that we are starting student loan payments again in October. That both helps give relief for student loans, but also sets people up for success to be on an income-driven repayment plan that is not too much of a burden, so that way they can pay back their loans, but also, live a comfortable life and have some options towards getting this relief.
And to your point, actually, the 4 options I mentioned in the beginning, they are looking to actually really streamline them. So there'll probably be like maybe 2 instead of 4. So save is here. Save is to replace repay, but the one that's most likely going to stay is the income-based repayment plan, IBR for short. And it's actually advisable folks that have started with that program. It's advisable they stay in that and they don't switch to save. If you are right now making more income than you made in the past, because with switching to save, you'll end up paying more just because you'll have to recertify your income on an annual basis. So it is very important that you talk to a tax expert, a financial advisor, a financial planner to fully understand the impact before you make those decisions. But it is definitely, the options are there, but before you pull the trigger, that's the question.
Yeah, I think those are really good points. We want to talk to experts, want to talk to a CPA, tax professional, financial planner, financial advisor, somebody that can help you make the right decision on whether to stay with the current plan you're on, consolidate and go into save. But if you do have student loans, just be mindful that, it's important to start making those payments again in October. If you're on an income-driven repayment plan, odds are pretty good that your monthly payment's going to be a little bit lower. And there's some nuances to whether or not you choose to married filing joint or married filing separate, and what's the right one for you as it relates to that income that they're using towards the repayment plan. Patrice, thank you so much.
My pleasure, Chris.